to the pen, to the king. Where's my crown? That's my bling. Always drama when I ring. See, I believe that if I see it in my heart, smash through the scene.
I'm here today at Petronas gas station where my group, Group 12, will be presenting about Petronas and its competitor, Petron. Now before I want to talk about the competitor, Petron, I want to go over Petronas. Petronas is Malaysia's state-owned oil and gas company that was established in 1974 and has since then become the cornerstone for the nation's energy landscape. And it operates from its iconic headquarters, the Petronas Twin Towers, that's located in Kuala Lumpur. Petronas has become and played a pivotal role in shaping Malaysia's energy infrastructure over the years and has since then significantly contributed to the country's overall economic and growth and development.
Hello everyone, my name is Musa Iman Abdullah and I'll be talking about Petron Corporation. So Petron Corporation, founded in 1933, is the Philippines' largest oil refining company. It operates a refinery with a capacity of 180,000 barrels per day, supplying over a third of the country's oil needs. Petron also has its operations in Malaysia. Okay, some of the products and services of Petron include things like LPG, which is a liquefied petroleum gas, lubricants, service stations, Petron car care centers, and loyalty programs. Thank you.
So I'll be presenting the history of Petronas. So Petronas is basically a state-owned oil and gas company established on August 17, 1974 under the development arm of petroleum. And it was created to manage and conserve the country's oil and gas resources. Though it is innovative production sharing contract (PSC) system, Petronas partnered with various other international companies while maintaining control over Malaysia's resources. In the 1980s, Petronas expanded into downstream activities, building its first refinery in Kerith, Terengganu, and developed LPG facilities. During this time, it is also ventured internationally, securing projects in Vietnam and Sudan. So, in the 1990s, Petronas rapidly expanded globally, operating in over 30 countries and becoming a major player in the oil and gas industry. It also grew into liquefied natural gas, known as LNG, becoming one of the world's largest exporters. This era saw the construction of the iconic Petronas Twin Towers in Kuala Lumpur, symbolizing Malaysia on the global stage and housing the company's headquarters. And then we'll move on in the 2000s. Petronas emphasized innovation by focusing on deep water projects and advancing technological applications. The company expanded its global presence through strategic partnerships and acquisitions. By the 2000s, it shifted its attention to sustainability, investing in renewable energy and low carbon technologies in response to global climate change. So we'll be continuing with the product and services for Petronas. So the company focuses on 4 key businesses area. First one is gas processing, second gas transportation, third regasification, and fourth one is utilities. By prioritizing innovation and sustainability, Petronas continues to lead the way in driving Malaysia's energy sector into the future.
Get out my car. And now moving into financial ratio analysis, I'll be covering Petronas's liquidity ratios. So firstly, current ratio. Petronas's overall current ratio indicates a significant drop, going from having a ratio of 3.64 in 2021 with a slight increase of 3.69 in 2022, leading to a massive drop to 1.89 in 2023. While still far exceeding the industry benchmark of above 1.5 to 2.0, For gas and oil industries, these numbers indicate that Petronas Berhad's ability to meet its short-term obligations has weakened. Moving on to the quick ratios, in 2021, Petronas demonstrates a quick ratio of 3.61, and in 2022, it still stands strong with a ratio of 3.66. These numbers indicate a very strong liquidity, meaning Petronas is well prepared to meet its short-term liabilities. However, in 2023, it proceeds to drop to 1.87, which suggests a decrease in the company's ability to meet short-term obligations without relying on their inventory. So lastly, for liquidity ratios is cash ratios. Overall, Petronas Berhad's cash ratio has significantly decreased from having 2.92 in 2021, which indicated at first a extremely strong liquidity, to a sudden drop to 0.09 and 0.04 in 2022 and 2023, which means Petronas has low cash liquidity, overall leading to a decrease in the company's immediate liquidity. Now, I'll move to debt ratios. So if we refer to the table here, I'll be starting off with the total debt ratio. So Petronas' total debt ratios has overall managed to maintain a conservative financial structure, going from 0.30 in 2021 with a slight increase to 0.32 in 2022. This is already an impressive number by Petronas, since it showcases prudent financial management, having sufficient equity whilst using moderate levels of debt to support growth. It does decrease, however, in 0.28 in 2023, which further shows that Petronas relies less on debt and more to equity to finance its assets. Now I want to talk about debt to equity. So in 2021, Petronas started with a debt to equity of 0.28, which slightly increases to 0.31 in 2022. This was considered a conservative and financially stable approach by them to maintain their financial security. However, they do drop to 0.25 in 2023, which strongly suggests that Petronas highly relies on their equity, and again with limited use of debt. Finally, going over the last part of debt ratios is equity multiplier, going from 1.44 in 2021 to 1.47 in 2022. Petronas once again highlights its limited reliance on debt by dropping to 1.40 in 2023. To lower the multiplier ratio highlights their conservative financial structure and suggests that they hold a strong reliance on equity with modest use of leverage. Now, I will talk about profitability ratios. However, now I'll move over to profitability ratios, starting with the first one, profit margins. Petronas' profit margins has noticeably decreased, having 37.37 in 2021 to 28.54 in 2022. This may be possibly due to their production costs or changes in oil prices, global oil prices. However, their margins then slightly recovered to 29.50 in 2023. Overall, Petronas still demonstrates a high level of profitability relative to their sales, demonstrating their resilience and adaptability. Now, I'll move on to return on assets. So, in 2021, Petronas achieves a high return on asset of 11% to 8.93% in 2022. This indicates that their assets may have grown faster than their profits. However, it does rise back up to 9.84 in 2023. The company maintains its efficiency in utilizing its assets to generate profit. And lastly, for profitability ratios, I'll talk about return on equity. So the return on equity starting strong with 15.84% in 2021, their ROE drops to 13.11 in 2022. While still being strong, it's just that Petronas experiences a slight decline in profitability. However, it would later then recover slightly to 13.76 in 2023. Overall, Petronas is still consistently generating returns for shareholders' equity, but with a slight fluctuation in between their periods. And now moving on to market ratios. And now I'll move on to market ratios. So firstly, price earnings. Price earnings from 2021 started with 15.95, increasing to 18.54 in 2022, ending in 17.69 in 2023. The higher price earning ratio suggests that investors are willing to pay more for each dollar of sales. Now moving on to price sales ratio, going from a ratio of 6.31 in 2021 and declining. Now moving on to price sales, going from a ratio of 6.31 in 2021 and declining to 5.50 in 2022, ending with 5.43 in 2023. The lower price sale ratio indicates that investors are not willing to pay more for each dollar of sales. And lastly, for market to book, we will talk about the market to book ratios, which Petronas managed to remain a consistent ratio of 2.68 in 2021 to an increase to 2.85 in 2022. This overall ends in a ratio of 2.76 in 2023. These ratios are consistent and suggest that investors believe the company's assets are worth more than their book value. Now finally, I will cover activity ratios, starting with inventory turnover. Petronas Berhad starts off with an impressive 42.35 inventory turnover rate in 2021, which improves even further in 2022 with 65.01, and then ends off with 77.99 in 2023. High inventory turnover ratios like these suggest that Petronas company is selling and replenishing inventory very, very quickly. And secondly, I want to cover receivables turnover. Starting in 2021, ratios are 178.03, which further increases to 215.02 in 2022, ending off with 174 in 2023. With these high receivable turnover values, we can strongly assume that Petronas collects its receivables very, very quickly. And lastly, I want to cover the last activity ratios, which is payables turnover. Petronas achieves 16.88 in 2021 with a slight drop to 15.73 in 2022. Petronas begins to increase in 2023 with 51.84. This high number of payables turnover suggests that Petronas is extremely quick in paying their suppliers. That is all for me, Aiden Harris. Now I'll move on to my next member.
Hi everyone, my name is Adil Najmuddin and I will be talking about the financial ratio analysis of Petron. Let's start with liquidity ratio, which measures Petron's ability to meet short-term obligations. In this, the current ratio improved from 0.97 in 2021 to 1.28 in 2023, indicating a better position to cover liabilities with the current assets. Similarly, the quick ratio increased from 0.55 to 0.76, showing enhanced financial flexibility without depending on inventory. However, the cash ratio declined from 0.12 to 0.058 during the same period, signaling a reduction in immediate liquidity. Overall, this trend suggests that while short-term financial health is improving, the company's reliance on cash reserves has weakened. Moving on to debt ratios, which assess the company's reliance on borrowed funds. The total debt ratio dropped from 0.78 in 2021 to 0.48 in 2023, reflecting reduced dependence on liabilities for asset financing. The debt-to-equity ratio also decreased significantly from 1.18 to 0.94, highlighting shift towards equity financing. Lastly, the equity multiplier fell from 2.18 to 1.94, showing that Petron is relying less on leverage to finance its assets. These improvements indicate a healthier capital structure which reduces financial risk. Next, let's analyze profitability ratio, which reveals the company's ability to generate profit. The profit margin decreased from 2.76% in 2021 to 1.63% in 2023, showing decline in efficiency in converting sales into profits. The return on assets also dropped from 8.01% to 5.79%, reflecting reduced asset utilization. On the other hand, the return on equity peaked at 13.56% in 2021 before declining to 11.2% in 2023, suggesting variability in returns of shareholders. These trends indicate that while profitability remains positive, the company faces challenges in maintaining its margins and efficiency. Now let's examine the market ratios, which provide insights into investors' perception. The price-earning ratio fluctuated, declining from 5.12 in 2021 to 4.42 in 2022, but rebounding slightly to 4.51 in 2023. The market-to-book ratio steadily decreased from 6.4 in 2021 to 5.11 in 2023, signaling reduced investors' confidence. Similarly, the price-sale ratio dropped from 0.17 to 0.12, reflecting a lower willingness among investors to pay for each dollar of sales. These downward trends indicate a cautious market outlook for Petron. Finally, let's look at activity ratios, which measures operational efficiency. The inventory turnover improved from 9.67 in 2021 to 15.87 in 2023, indicating better inventory management. Although there was a little slight decline from 2022. The receivable turnover increased slightly to 27.89 in 2023, showing improved efficiency in collecting payments. The payable turnover ratio rose significantly from 8.21 to 16.41, highlighting quicker payment to suppliers. Overall, these ratios show that Petron has made strides in operational efficiency, particularly in managing inventory and receivables. So, to wrap it up, Petron is getting better at handling short-term debts, and it's relying less on borrowing, which is great. But profitability is slipping a bit, and investors seem less confident based on market ratios. The good news, they're doing a solid job managing operations like inventory and receivables. Thanks for listening.
Any last words?
Long live Petron.
Now let's talk about financial strength and weaknesses for Petronas. So first of all, I'm going to talk about liquidity. Strong liquidity ratios shows that Petronas is in a good position to fulfill its short-term obligations, which is important in a sector where operating costs are considerable. Now, second one is profitability. High margins are a sign that Petronas is effectively turning a profit, which is essential for the company long-term viability and capacity to compete in non-financial sector. And third one is efficiency. Strong operational performance would be shown by high asset and inventory turnover ratios, which would indicate effective resource management. And lastly, leveraging Petronas is managing its debt responsibility as evidenced by a solid interest coverage ratio and balanced debt to equity ratio, which ensures financial stability. Bro, why you smell so bad?
Me? Smell so bad?
Yeah.
Huh? Why so bad?
Let's talk about the weaknesses of Petronas. So first, profitability volatility. According to the nature of the energy industry, there is a chance that shifting prices for gas and oil cause variation in profit margins. Leverage. Petronas may be financially vulnerable due to its high debt levels, particularly in times of economic recession of declining energy prices. Now, second, the efficiency. Low inventory turnover or assets turnover ratios may be a sign of underutilization of assets, which can result in inefficient capital allocation and operational process. Yeah. My name is Lil Keems. I want to talk about
Hey, it's me, the editor. I forgot to put the strength and weaknesses for Petron, and now I'm gonna put it. So first of all, I'm gonna talk about strength of Petron. So Petron has enhanced its ability to meet short-term obligations using its current assets. And second one is withstanding several obstacles, the business keeps making money for its investors and has demonstrated signs of stabilizing its operational performance in the past year. So the company has low dependency on inventory to cover short-term liabilities, which improve financial stability and has better operational flexibility. And lastly, for strength, Petron relies more on equity than debt for financing, and this reduces financial risk as the company has lower obligation to creditors relative to its shareholder funds. So for weaknesses, the company may be at risk in circumstances requiring prompt financial actions or unexpected cash outflows because its immediate access to cash and has drastically decreased. And secondly, for weaknesses, overall profit margins and return on assets and shareholder equity have been declining over the time, and Petron has become less effective at using the assets to make profits, suggesting possible inefficiencies during the operations.
Now I'll be presenting about investment analysis and recommendations. In the oil and gas industry, Petronas and Petron are both major participants. They differ in terms of recognition, reputation and ownership. Petronas is owned by the Malaysian government, benefits from strong ties with government agencies, access to funding support and extensive advertising opportunities. This company operates in over 50 countries, primarily in Asia, for example Malaysia, Indonesia and Thailand. And they also operate in some of the African countries like South Sudan and Nigeria. They also have ongoing oil projects in the Middle East, including Iraq and Egypt. So globally, Petronas is well known for its partnership with Mercedes-AMG in Formula 1, achieving global recognition, often led by the iconic driver Lewis Hamilton. This success has significantly boosted the company's global reputation and brand visibility. For investors seeking stable bonds or long-term opportunities, Petronas is a strong choice. With support from government-linked funds like Khazanah Nasional Berhad, Petronas delivers consistent returns. So for investors currently holding Petronas bonds are advised to return them. The company is well prepared to face industry challenges such as fluctuating oil prices and the shift toward electric vehicles.
And lastly, for investors concerned about the declining reliance on oil due to the rise of EVs, electric vehicles, and global geopolitical risks tied to fossil fuels.
Let's take a seat. So, as an investor who is interested in expanding their business in the Philippines, they should definitely invest in Petron because it allows partnership with the San Miguel Corporation. The San Miguel Corporation has a lot of influence and contacts both within the Philippines and the Malaysian market. Therefore, it is very easy to expand businesses both in the Philippines and in Malaysia. Let's take a quick ride to the nearest Petron station. Hey, I'm down here. Alright, so if you do own shares in Petron, you should definitely keep it, but don't expect any significant return as their revenue is not that high. But do be wary about the fluctuations in the oil market, which happens really frequently. So Petron's natural geographical location will not... What you looking at? I said Petron. Where was I? Oh yeah, so if you do have shares in Petron, you should definitely keep it, of course. But if you do intend to sell it, do sell it. Alright, we're back at Petron. Are you satisfied? Alright, so if you are an investor who is intend to sell
Lastly, investors who are based in the Philippines should maintain their shares, but the investors who are based in Malaysia should choose to sell their shares because of the low rate of dividends, and also because due to the rise in the EV vehicles, Petron investors should also be wary that electronic vehicles will overtake petrol consumption and cause even lesser income.
So which one is better for investors to invest in? Well, the answer is obviously Petronas. Petronas, in terms of profitability, liquidity, and also global reach, is better than Petron. If they are looking for stability and safety over the long run, they should invest on Petronas. But if they are willing to take more risk but lower the income, then they should invest on Petron. So the answer is Petronas is better suited for investors.
Get the fuck out, yo. You sitting there playing with